How are you all? My name is Mr. J.M. Kimani, a lecturer in Management Accounting. Welcome to Lesson 3 of Marginal and Absorption Costing topic. Now, in Lesson 3, we are going to focus on the applications of marginal costing. Now, we have two applications of marginal costing, namely the cost volume profit analysis and also the non-routine decisions. So we have the two applications. We have the cost volume profit analysis, which is CVP, and we have the non-routine decisions. Now, these are the two applications, and these are the two we are going to look at as per the marginal costing. That we use the marginal costing concept in maybe valuing or determining or making decisions concerning the cost, volume, profit, and also the non-routine decisions. So we shall begin with cost, volume, profit. We shall begin with the cost, volume, profit analysis, CVP. Cost, volume, profit analysis, CVP. Now, what is CVP? This is the study of interrelationship between costs, volume, and profits at various levels of activities. It is used to study the behavior of profits in response to changes in volume and price. It is a tool used by management to determine the usefulness of profit planning process. It uses contribution concept as fixed costs are assumed constant irrespective of the number of units produced. In the short run, cost and prices of the firm's products are constant irrespective of the number of units produced. In the short run, cost and prices of the firm's products are generally well determined, and therefore the only factor affecting profitability of the product of the business is the level of activity, that is the volume. Now, CVP may be used to make short-term decisions such as determining the break-even point, 2, sales to achieve a given target profit, and 3, most profitable sales mix. Now, we are saying that CVP is an approach and a technique that we use to study the interrelationship between the cost, volume, and profit. In actual sense, profit is a function of some determinants like the cost, the price, as well as the volume. That should any of these change, should the price, the cost, and the volume change, then the profit will also change. So when we are looking at the relationship and the effect of these changes on profit, then that one we can be able to say that we are using the CVP. Now, in the short run, we expect of those three determinants, the price, the cost, and the volume, we expect the price and the cost to be well determined and therefore not changing. Only the volume or the activity level will change. That's what we expect in the short run. But actually, in the long run, we may have the prices or the cost changing. That is an assumption that we are going to use. Now, when we apply CVP, we can apply CVP in decisions like determining the level of break-even. The level of break-even is that level where we make no profit, we make no loss, and therefore the profit is zero. It's actually that level where the revenue equals the cost. We can also use the CVP in making decisions concerning the target sales so that we can be able to achieve a particular profit. So if you're targeting a particular profit, then what should we sell? What level of activity should you operate at that we can be able to achieve that level of profit? And the last decision is that we can apply it in making decision concerning the sales mix. In case we are having multi-products, maybe 2 products, in what mixture should we use this so that we can be able to achieve the best? So we need to also advise based on the mixture or the proportions of these products. Those are majorly areas where we are going to apply this CVP. Now, the assumptions of CVP. Assumptions of CVP. Now, assumptions, I'll give the following assumptions. Number one, cost can be separated into fixed and variable elements. Number 2, total fixed cost is assumed to remain constant over the relevant range. Number 3, variable cost per unit is assumed to remain constant over the relevant range. Number 3, selling price per unit is assumed to remain constant over the relevant range. Number 4, all units produced are sold such that there are no closing inventories. Number 5, only one product is produced, and in case of multi-product, a constant sales mix is assumed. Number 6, volume is the only factor or driver affecting profit. Number 7, there is linear relationship between volume and costs and profits. Number 8, the level of technology, efficiency, and production methods remain constant. And the following assumption is that there are no demands, no constraints, no restrictions in production and sales. And the last one is that due to short-term periods, there is no time value of money, among others. Now, we are saying that we have these as the major assumptions of CVP, where we assume that, like the first one, the cost is either fixed or variable. Entirely fixed, entirely variable. There's no semi. Number 2 is talking of the total fixed cost remaining constant, which is true. So over the relevant range means that if, for example, we have ever produced from 100 to like 500 units. So within that range, we can be certain that the fixed cost remain constant. If the fixed cost like rent has been constant at a rate of like 100,000, it's going to remain that way per period. But should we produce more than that 500, the upper level we have ever produced, we don't have the certainty that the fixed cost will remain constant. We may require some more premises. When talk of the variable cost being constant per unit, which is very true because we are assuming there is not going to be any economies of scale or diseconomies of scale. We expect this to be constant throughout. Selling price being constant, we expect no discounts on bulk purchases. So we're going to give and charge customers whatever volume they're buying, every unit the same price. Another one is that all the production is sold. You don't want to have a problem of the closing inventories being valued and having some cost share, where the revenue is for a lesser level of activity and cost is for a higher level of activity. We don't want to have them equal. Now, but again, we can have a situation where a company is dealing with more than one product. So if that's the case, then we are going to presume a constant mix, a constant sales mix. If it is a ratio of 2:1, it should be maintained from the beginning to the end of the period, not changing in between. We can also have a case where there is expected linear relationship between the volume and the profit, volume and cost, such that the higher the volume, the higher the profit. We expect that. And that's why you have another assumption that volume is the only factor, is the only driver affecting profit. And therefore, the profit becomes a function of that volume. We also have a case where the technology, the level of efficiency, and the method of production are not changing, should remain constant. So if we maintain the same level of efficiency from the beginning to the end of the period, we are going to have some budgeting and some model being established. But again, if we are having that kind of change of technology, change of methods of production, of course we can be able to model these as we are going to do. We also have a case where in terms of demands, the constraints, the restrictions, you may want to produce, but there's not enough materials. You may want to sell, but there's no demand. So we don't have that kind of a problem. We would want where we have freedom, that if we want to produce higher, we can produce higher. If we want to cut down our production, we won't have a problem with the customers. Like we may have signed some contractual obligations. We do not want such kind of restrictions. Also, the issue of time value of money is a case where the period is short, such that we are having no problem in terms of the value of money at the beginning of the period and the value of money at the end of the period. It's a short period, like say a week, 1 month, or even less than a year, that is. So those are the assumptions that we expect to apply as we are going to model. Now, we are going to have the basic model of CVP, and is actually the certainty model. So we're going to have here, all this we are doing are certainty models. This is certainty or basic CVP model. CVP model. So where we have made that assumption, and at the same time, we are also going to look at the single product. This is, we can have like Roman 1, this being single product. Now in single product, we would require to have some functions of CVP as follows. But before that, let's look at the variables. So you can have we have X, we have P, we have R, we have V, we have F, we have C, we have pi. So representing the following. That X represents the level of activity or volume. So this is level of activity, meaning volume or output. Then you have P representing selling price. And selling price, of course, is per unit. R representing total revenue. V representing variable cost per unit. Variable cost per unit. F representing total fixed cost. Total fixed cost. C representing total cost. Total cost. While pi representing total profit. Total profit. And others include the following. We can have the following. For example, we have T. T represent target profit, target profit. We have XB representing break-even point in units, RB representing break-even point in shillings, XT representing break-even point, this is not break-even but representing target sales in units, while RT represents target sales in shillings. Now, when talk of the break-even point, we would also want to have that kind of explanation that BEP represents break-even point, break-even point.